A 28-year-old investor proudly told his friends he had finally figured out investing. Every month he bought the same thing: an S&P 500 index fund. Social media told him it was unbeatable. Finance influencers called it guaranteed wealth. Everyone repeated the same sentence: just buy the S&P 500 forever. For 3 straight years, his portfolio exploded upward. He felt like a genius. Then 2026 arrived. Suddenly, volatility surged, tech stocks started shaking, market concentration hit extreme levels, and the exact strategy that once felt safe suddenly looked terrifying. And the scary part? Most investors still do not understand the trap they are standing inside. If you are investing in the stock market right now, comment the word discipline below, because what you are about to hear may completely change how you think about passive investing, diversification, and the future of wealth creation. Now, before people panic, let's make something clear immediately. The S&P 500 is still one of the greatest wealth-building tools ever created. Historically, broad index investing has beaten most active investors over long periods. Even many professional money managers fail to outperform it consistently after fees. But that is exactly why the trap became so dangerous. Because millions of investors stopped thinking critically. The strategy became a religion. People stopped asking, what exactly am I buying now? And in 2026, that question matters more than ever. The first thing most investors do not realize is that the S&P 500 is no longer as diversified as they think. A handful of giant technology companies now dominate the index to a degree not seen since the dot-com era. Reuters recently reported that the Magnificent Seven now account for roughly 1/3 of the market's value and over 37% of the MSCI USA index. Another report warned that the top 10 companies now represent over 40% of the S&P 500, even higher concentration than during the 2000 bubble. Think about what that actually means. Millions of ordinary investors believe they own a safe, diversified portfolio, when in reality, huge portions of their wealth are heavily dependent on AI optimism, mega-cap tech, semiconductor growth, and continued enthusiasm around a few companies. That is not true diversification. That is concentration disguised as diversification. And honestly, most investors have absolutely no idea. One analysis explained it brutally. For every $1,000 invested in a standard S&P 500 fund, more than $300 may effectively be concentrated in just 7 companies. That creates enormous vulnerability. Because if those companies slow down, the entire index feels it. And this is where the first major trap appears. The S&P 500 performed so well during recent years that many new investors now believe large gains are normal. That belief becomes dangerous during bubbles. One Reddit commenter said, "You can immediately recognize investors who only started during the recent bull market because they think every small decline is temporary and every rebound is guaranteed." And honestly, that observation may be painfully accurate. Many investors today have never experienced a prolonged bear market, a lost decade, or true valuation compression. They only know, buy the dip. But history shows markets do not always recover quickly. Another warning from Bank of America described the market as priced for perfection, meaning investors are assuming almost everything goes right from here. That creates fragility, because expensive markets leave little room for disappointment. And disappointment always arrives eventually. Maybe not tomorrow, maybe not this year, but eventually. And this leads directly to the second trap. Passive investing became so popular that it may now be reshaping market behavior. Think about this carefully. Traditional investing rewarded analysis, studying companies, understanding valuations, evaluating risk. But passive investing ignores fundamentals entirely. Index funds automatically buy more of whatever already became biggest. That creates a feedback loop. The larger companies grow, the more index funds buy them, which pushes them even higher, which increases their weighting further. One investment report warned that passive investing has quietly transformed diversified investing into a concentration bet driven by momentum flows. And honestly, this is where 90% of investors psychologically fail. Not because they lack intelligence, but because they misunderstand risk. They think S&P 500 cloaks guaranteed safety. No. The S&P 500 historically rewarded patience over long periods. That is different from safety. Huge difference. And what happens next destroys most investors emotionally. When markets finally become painful, investors discover their true risk tolerance was fake. Everyone says they can handle volatility until their portfolio drops 20%, 30%, or 50%. Then panic begins. One Reddit discussion during recent volatility showed investors arguing intensely over whether markets were cheap after corrections, while others warned earnings had not fully collapsed yet. That confusion always appears near unstable periods or emotional comfort, and it absolutely does not guarantee future returns will resemble the past. Many investors are unconsciously anchored to the extraordinary gains of the last decade. Low interest rates, massive liquidity, AI excitement, tech dominance, and relentless passive inflows. But several strategists now warn that future returns could be much lower and far more volatile. Why? Because markets change, economic regimes change, interest rates change, technology cycles change. Because many passive investors unknowingly became heavily overweight technology without realizing it. And here is where the real danger appears. Most people are not psychologically prepared for a long period of mediocre returns. That is what could break them. Not one dramatic crash, but slow disappointment. Imagine, inflation remains elevated, returns weaken, volatility increases, and the S&P 500 underperforms expectations for years. Most passive investors have never emotionally prepared for that possibility. And the market punishes unrealistic expectations brutally. That decision alone will financially break many people. But what happens next may matter even more. Investors start chasing alternatives desperately. Speculation explodes, leverage increases, meme stocks return, cryptomania resurfaces. People abandon discipline entirely. That cycle happens repeatedly throughout financial history. Because when easy gains disappear, greed becomes reckless. And honestly, that may be the real S&P 500 trap. Not the index itself, but the false sense of certainty it created. Millions of investors now believe investing became easy. Just buy one fund forever. Never think again. But investing was never supposed to be emotionally easy, and markets eventually punish complacency. Now here is the important part most fear-based videos never explain properly. This does not mean sell everything. That decision destroys people too. Historically, investors who panic sell during fear periods often permanently damage long-term returns, cash reserves, and realistic expectations. One strategy report warned that relying too heavily on the S&P 500 alone may now increase vulnerability, because concentration risk has become unusually extreme. The people most vulnerable in 2026 may not be cautious investors. They may be investors who became convinced markets only go one direction. History punishes that belief repeatedly. The dot-com bubble punished it. The housing bubble punished it. The meme stock mania punished it. And every generation believes this time is different. Maybe AI really does transform the world massively. Maybe mega-cap tech keeps dominating. Maybe the S&P 500 continues climbing for years. That is entirely possible. But intelligent investors prepare for multiple futures, not just the optimistic one. And honestly, and there is one final truth most investors do not understand until it is too late. The greatest threat to wealth is usually not a crash. It is unrealistic expectations combined with emotional behavior. Because when people expect endless gains, even normal corrections feel catastrophic. And that emotional instability is exactly why most investors fail. Not because the S&P 500 stopped working, but because they psychologically could not survive the periods when it stopped feeling easy.